Welcome to this explainer. Today, we're stepping away from all the noise, the hype, and those overnight success stories that usually crowd the trading space. Instead, we're taking a calm, highly analytical look at week 23 of the GoldMining Ninja Challenge. We're tracking a live USDJPY cent account and documenting its very real, very methodical journey from a $25 starting point straight toward a $100 goal.
Okay, let's dive into this. What you're seeing here really reflects the reality of the strategy. It's highly focused and it is entirely about capital preservation. See, this week's story isn't about massive, aggressive swings. It's about controlled execution. We're looking at the absolute realities of algorithmic trading, where the primary objective is to simply protect the downside while letting those incremental gains slowly compound over time.
Section 1. Weekly Performance Breakdown, Controlled Execution.
To truly understand what makes this strategy tick, we have to look at the micro-level results. It's all about appreciating strategic, non-aggressive trading. It's not about what you can make in a single day, it's about what you can consistently secure without risking the entire account. This past week, the account saw a growth figure of exactly plus 0.38%. Now, to the untrained eye, that might seem, well, incredibly small. But in the context of capital preservation, it actually represents successful, disciplined consistency. It means the algorithm operated exactly as intended through a pretty complex market environment, completely avoiding unnecessary exposure.
In absolute terms, that percentage translates to a weekly profit of $27.06. Again, this deliberate, unhurried accumulation is the true nature of algorithmic compounding. It's really the quiet, mechanical gathering of fractional profits that ultimately builds the foundation for long-term survival.
When we checked the maximum drawdown for the week, it was kept incredibly tight at just 1.88%. So to secure our 24.39 cents in gross profit, plus an additional 2.67 cents in positive swaps, the risk taken was absolutely minimal. And that right there is the very definition of controlled execution.
Section 2. Trading the USDJPY trend. Macro catalysts.
So the crucial point here is that algorithms don't operate in a vacuum. They have to interact with the fundamental realities of the global economy. This week, understanding those macro drivers is absolutely key. The USD-JPY pair remained highly elevated, hovering right near that critical 160 level. And why? Well, primarily because the Bank of Japan maintained a significantly looser monetary stance compared to the Federal Reserve. Fed rate expectations and strong Treasury yields continued to support the dollar, even while market participants kept a very nervous watch for a potential currency intervention risks from Japan. These macro conditions translated directly to the price action we saw on the 15-minute time frame. We've got a clear, persistent uptrend channel supporting continued dollar strength, but it's punctuated by these sharp, short-term pullbacks. Now, for an algorithmic strategy, this is actually an ideal environment. The macro fundamentals support the long-term trend, while those micro fluctuations create exactly the short-term volatility the strategy needs to trigger and close its positions.
And this brilliantly illustrates exactly how the EA capitalized on that specific environment. Just look at the two precise, profitable buy trades closing out, one yielding 12.72 cents and the other 11.67 cents. The algorithm effectively rode the continued dollar strength against the yen, entering during those localized dips and exiting right as the overarching trend resumed.
Section 3. Navigating Floating Equity, the Reality Check.
Now, if we only talk about closed profits, we really aren't telling the whole story. Transparency is paramount for us, so let's explicitly define these two concepts. Your realized account balance is the total of all your closed, secured trades. It only goes up when a profit is actually booked. Floating equity, however, includes the real-time value of all your currently open positions, meaning if you're holding trades in a temporary loss, your equity is going to be lower than your balance.
Now, what's really interesting about this is the clear separation between the realized account balance and the floating equity. The account balance has marched straight up to a new high of $7,110.18, but the equity is visibly lower, sitting at $4,682.46. Zooming in on the weekly detail, we can actually see this equity pressure in real time. But here's the major reality check you need to take away from this. This divergence is definitely not a flaw. Actually, it's a completely normal, expected feature of a grid or averaging strategy navigating current market conditions. The algorithm is just holding open positions, absorbing the market's breathing room, and waiting for the structural reversion to clear those trades. This is exactly the kind of sweat equity required in algorithmic systems.
Section 4. Long-term trajectory, the macro view.
Zooming out from all that weekly noise, the comprehensive data shows the undeniable results of this approach. Despite the equity fluctuations we just talked about, the realized balance is sitting incredibly strong at over 7,100 cents. The historical gross profit heavily outweighs the gross loss, completely proving the long-term viability of prioritizing capital preservation above all else.
Let's move to and see how this builds over time, because it reveals a truly exceptional growth curve. The total growth metric has officially crossed a massive milestone, plus 202.57% total growth since the very start of this $25 challenge. That is the raw power of systemic, robotic execution over many months.
To put that into perspective, this account is now roughly 71% of the way to its final 10,000 cent or $100 target. Just let that sink in for a second. 71% completed, not through massive wild gambles, but through pennies at a time. It proves the supreme importance of consistency and mechanical discipline over the short-term excitement that honestly ruins most traders.
Which brings us to our final thought for this explainer. This journey isn't some simulation. Real accounts, real risk, real progression, road to 100 continues. As you look at this disciplined climb, you have to ask yourself, are you building a trading approach based on daily thrills, or are you actually building an infrastructure for long-term survival? Thanks for joining us, and stay focused.